His name is Michael. He's been selling silver for 17 years, built his business from a single coin shop to a regional operation doing $43 million in annual sales. Last Tuesday, he locked the doors for the final time. Not because customers stopped buying, because his bank pulled his credit line and he couldn't afford to stay open another week. This is his story. This is what's happening to mid-tier silver dealers across America, and this is why the retail silver market you depend on is collapsing faster than anyone publicly admits. I met Michael in June. He reached out after reading about dealer credit constraints. "You're writing about the crisis," he said, "but you don't know how bad it really is. Come to my warehouse, let me show you what's actually happening." So I went. What I found was a business in its final death spiral, and a man willing to break every non-disclosure agreement he'd ever signed because, in his words, "They already destroyed me. What else can they do?" Michael started in silver in 2007, saw the financial crisis coming and believed in the thesis. Real money, real assets, protection against the system, opened a small coin shop in Ohio, did $50,000 in sales the first year, built local customer relationships, grew steadily. By 2015, $8 million annually, 3 employees, larger retail space, added online sales, profitable and sustainable. Then he decided to scale up. "In 2018, I wanted to compete with the majors," Michael explained. AppMex, JM Bullion, SD Bullion dominated online sales. I thought I could take market share with competitive pricing and faster delivery, asked my bank for a credit line to finance larger inventory. The bank gave him $2 million. Collateral was inventory plus personal guarantees. Interest rate prime plus 2%. With $2 million in credit, he could buy in volume, get better wholesaler pricing, offer competitive retail prices, turn inventory quickly. The model made sense. For 3 years, it worked perfectly. By 2021, $28 million in annual sales, 12 employees, substantial warehouse, credit line increased to $5 million. He was competing with regional operations and taking business from nationals. "Best years," he said, growing 30 to 40% annually, profitable, customers happy, everything sustainable. Then 2023. Banks got nervous about precious metals. Michael's bank called March 2023. "Reviewing your credit facility, need to discuss collateral." Dollar for dollar became 1.25 to 1. His $5 million effectively became $4 million. Thought it was temporary, adjusted, cut product lines, focused on higher margins, reduced inventory, hurt growth but still profitable. Not temporary. September 2023, collateral hit 1.40 to 1. Effective credit dropped to 3.5 million. January 2024, facility cut to 3.2 million. Same collateral, less credit, no explanation beyond risk management protocols. With 3.2 million, Michael couldn't maintain inventory to compete. Buying 100,000 ounces monthly in 2022. Early 2024, only 60,000. Lost volume discounts. Per ounce acquisition costs up 12 to 15%. Couldn't raise retail prices that much because big dealers weren't raising theirs. They had more credit, still got volume discounts, squeezed both sides. Pressure built through spring 2024. Margins compressed from 18 to 11%. Still profitable, barely. Laid off 4 employees. Reduced warehouse space. Stopped marketing. Survival mode. Every month trying to make numbers work. Hoping credit would improve. Hoping to hold on until normalizing. June hit. Bank called. "Reducing your facility to 1.8 million effective July 1st. Non-negotiable." From 3.2 to 1.8 million. 44% cut. 30 days notice. Michael couldn't operate at 1.8 million. Monthly inventory purchases alone required 2.5 to 3 million revolving credit. Went to 3 other banks for alternative financing. All said same thing. Not doing precious metals lending now. Too much volatility, too much risk. Can't help you. Tried everything. Private lenders quoted 12 to 15%. Math didn't work. At those rates, need 25% margins to break even. Impossible in competitive market. Reached out to larger dealers about acquisition. They lowballed, offered 40 cents on dollar for customer list and inventory. Knew I was desperate, no leverage. By mid-June, operating on fumes. Couldn't buy new inventory, selling down existing stock. Customer orders delayed or canceled. Online reviews turning negative. Once reliability reputation is gone, you're finished. Customers won't tolerate delays. They go to AppMex or JM Bullion and pay slightly higher premiums for guaranteed delivery. The end came late June. Customer placed large order, $250,000. Wanted delivery in 2 weeks. Michael accepted, desperately needing cash flow, but couldn't source inventory within credit limits. Had $180,000 in credit available. Order required $230,000 inventory purchases, $50,000 short. Went to bank begging for temporary increase. They said no. Tried to cancel customer's order. Customer threatened legal action. Michael took cash advances on personal credit cards at 21% interest to cover shortfall, bought inventory, fulfilled order, made $3,000 gross profit, paid $4,200 credit card interest, lost $1,200 on $250,000 sale. That's when I knew it was over. Losing money on large orders because couldn't access normal credit, business model mathematically impossible. Closed doors. June 28th, laid off remaining 8 employees. Started liquidating inventory. Have about $700,000 in inventory. Owe bank $1.8 million. Selling everything at cost to pay down debt. When liquidated, we'll still owe about $1.1 million. Coming out of personal assets, house, retirement, everything built for 17 years gone. We'll spend next decade paying off debt from business that was profitable until banks decided precious metals too risky to finance. Michael's story isn't unique. He gave me contact info for 4 other mid-tier dealers in similar situations. I reached out to all. 2 had closed, 1 in bankruptcy, 4th operating on 2-month timeline before closure. We're all getting destroyed by same thing. Credit withdrawal, can't compete with majors who still have credit, can't survive without credit. That's simple. Here's what makes this systemically important. Mid-tier dealers like Michael served crucial market function, provided regional competition to nationals, offered personal service, maintained local relationships, gave customers alternatives to massive online operations. When they disappear, market consolidates further into 3 or 4 majors who are themselves credit constrained. Michael showed me customer data, 42,000 customers over 17 years. After closure announced, got emails asking where to buy silver now. Tell them AppMex or JM Bullion. What else can I say? Those are only dealers with enough credit to maintain inventory. But they're dealing with same constraints, just bigger, so survive longer. When they hit wall, nobody's left. Human cost, devastating. Michael, 53. Thought I was building something for family. Son was going to take over, had plans to expand. Now starting over at 53 with 1.1 million debt and no business. Applied for jobs in industry. Big dealers aren't hiring. They're cutting costs too. Looking at corporate work if anyone will hire a 53-year-old whose recent experience is failed business. His employees equally affected. People who worked for me 5 to 10 years, specialized knowledge in precious metals markets, inventory management, customer service, doesn't transfer easily to other industries. 2 found jobs at pawn shops, taking massive pay cuts, others still looking. Michael's anger isn't directed at market forces or bad luck. It's directed at banks and the regulatory system. Banks created this crisis. They financed derivative positions that created exposure. They lent against fractional reserve allocated storage that overpromised metal. They financed the whole house of cards. Now pulling credit from legitimate businesses like mine to de-risk from their own mistakes. I wasn't doing anything risky. Buying physical silver and selling to customers. Safest business in precious metals. But got lumped in with all derivative exposure. Now paying price for their systemic risk. He showed me internal bank communications he received. Risk management protocols require reduction in precious metals, exposure across all business lines. That's the exact phrase they used. All business lines. It didn't matter that Michael's business was lower risk than derivative books. Bank needed to show regulators they were reducing precious metals exposure, so they cut credit across board. Michael's profitable, sustainable business got sacrificed to make banks' exposure numbers look better for regulatory reporting purposes. Here's what kills me, he said. The same banks that pulled my credit are the ones offering $150 buyback premiums for physical silver from large holders. They won't finance my business buying and selling silver at market prices, but they'll pay 6 times spot to acquire metal they desperately need. The hypocrisy is stunning. They're creating the shortage by preventing dealers from functioning normally. Then they're paying massive premiums to source metal because dealers can't maintain inventory. They're causing the problem they're paying to solve. Michael's closure ripples through the supply chain. His wholesaler lost a significant customer. I was doing $43 million in annual purchases from them. That's gone now. They're feeling it too. They told me 3 other regional dealers they supplied have closed this year. Their volume is down 30%. They're cutting their own staff. The refinery he bought from lost business too. They said I was one of their top 50 customers nationally. Reliable payments, consistent orders. Now that revenue stream is gone, they're seeing the same pattern. Mid-tier dealers closing everywhere. Their production capacity is down because their order flow declined. Even though physical demand from end users is strong, the dealer layer that connects refineries to customers is disappearing. This is market structure collapse, not just one dealer failing. The entire middle layer of the market getting eliminated because credit is being withdrawn. When the middle layer is gone, only the biggest dealers survive. And those dealers are constrained by the same credit limits. They just have more cushion before they hit the wall. Michael gave me his financial records to analyze. His business was profitable in 22 of the past 24 months through May 2024. positive cash flow, growing customer base, inventory turnover rates that were healthy. There was nothing wrong with the business fundamentals. What killed him was external credit withdrawal that had nothing to do with his operations. If someone had told me in 2021 that banks would just arbitrarily cut precious metals financing regardless of business performance, I would have structured differently, he said. I would have built cash reserves instead of growing. I would have stayed smaller and avoided debt. But the banks were encouraging us to borrow. They wanted the business. They financed our growth. Then they pulled the rug out when it served their risk management needs. He's not getting any sympathy from the banking system. I talked to my loan officer, asked why they cut my credit when my payment history was perfect. He said it wasn't personal. It was systemic policy. The bank was reducing precious metals exposure across all clients. My performance didn't matter. The category was flagged as high risk. Everyone in the category got cut. He actually apologized, said he thought it was wrong, but he's just following orders from risk management. The bankruptcy option would have protected some of Michael's personal assets, but he chose not to file. I personally guaranteed the loans. I could try to fight it in bankruptcy court, but that would take years and cost hundreds of thousands in legal fees I don't have. Easier to just liquidate, pay what I can, and negotiate the rest. The bank will probably settle for 70 cents on the dollar because they don't want to pursue litigation either, but I'll still be paying this off for a decade. Michael's warning to anyone in the precious metals dealer business: if you're operating on credit, you're operating on borrowed time. The banks will pull it when it suits them regardless of your performance. You need to have enough cash to operate without credit. And if you can't do that, you need to exit now while you can still get something for your business. Because when the credit dries up completely, you'll have nothing. His warning to customers: the dealers you're buying from are hanging by a thread. The big dealers you think are stable are dealing with the same credit constraints. They're just bigger, so they last longer. But the trajectory is the same. Credit is being withdrawn. Dealer capacity is declining. At some point, there won't be enough dealers with enough credit to maintain normal market function. When that happens, premiums will explode beyond anything you've seen. Or physical won't be available at any premium. The infrastructure is breaking. You're seeing it in longer delivery times and higher premiums. But it's going to get much worse. I asked Michael what he would do differently if he could start over. I'd never take on debt secured by inventory in a market where banks can arbitrarily withdraw credit. I'd operate entirely on cash, smaller scale, sustainable, no growth ambitions that require bank financing. Because growth that depends on credit is growth that can be destroyed by credit withdrawal. And banks will withdraw credit to serve their interests, not yours. His final message: this isn't about me. My business failed. I'll survive. But the market is dying. The middle tier is being eliminated. The infrastructure that connects physical silver to retail investors is collapsing. People think they can just go online and buy silver whenever they want. That's only true as long as dealers have credit to finance inventory. When credit is gone, dealers can't buy inventory. When dealers can't buy inventory, customers can't buy silver. The retail market will cease to function as you know it. And based on what I'm seeing, that's not years away. It's months. Michael's story is one dealer, but his story is repeating across dozens of mid-tier operations nationwide. The credit crisis isn't affecting hypothetical future scenarios. It's destroying actual businesses right now, and every business that closes reduces the market's capacity to deliver physical silver to the customers who want to buy it. The dealers are going bankrupt. The infrastructure is collapsing. And the people like Michael who built legitimate businesses serving real customers are getting crushed by a credit withdrawal that has nothing to do with their business performance and everything to do with banks de-risking from derivative exposure they created. This is the human cost of the silver credit crisis. Real people, real businesses, real destruction in communities across America. And it's accelerating as credit gets withdrawn.